Hello and welcome. I am Kunal from EPK Capital. For over 2 decades, I have had the privilege of helping families and investors navigate the complex, ever evolving landscape of wealth management. Over the years, I have seen asset classes emerge, evolve, and mature. Today, we are going to dive deep into a financial instrument that has captured significant attention, generated incredible curiosity, and undergone a massive regulatory transformation in India. Make sure to stay till the end for a special surprise that I have for you. And if you happen to like the content of the video, please do like and share the video. Also, do subscribe to our channel for learning everything from the world of investments and finance to make your future a secured one. Today, I am talking about peer to peer lending, commonly known as P2P lending. Whether you are looking to diversify your fixed income portfolio or simply trying to make sense of the modern fintech landscape, understanding how this ecosystem works is crucial. To truly appreciate where P2P lending stands today, we first need to look at how lending itself has evolved. Traditionally, if you wanted to earn a predictable return on your savings, your options were straightforward. You went to a bank and opened a fixed deposit. The bank would take your money, pay you a modest interest rate of perhaps 5 or 6%, and then turn around and lend that exact same money to individuals or corporations at 10, 12, or 15%. The bank pocketed the difference because they manage operations and absorbed risk. On the other end of the spectrum, India has a long history of informal, unregulated peer-to-peer borrowing. Think of neighborhood lending networks or traditional chit funds. While these offered high returns, they carried catastrophic risks and zero structural safety. Modern P2P lending was born as a technology-driven bridge between these two worlds. It cuts out the traditional banking middleman entirely, utilizing highly secure digital marketplaces to directly connect everyday investors who have surplus capital with verified individual borrowers or small businesses who need timely credit. Now, how does this marketplace model actually function on a day-to-day basis? It is remarkably systematic and it relies heavily on data. When a borrower requires a personal or business loan, they do not just post an ad online. They apply through a registered P2P platform. Instead of a single bank manager looking at a physical file, the platform uses advanced algorithms to instantly analyze the borrower's credit score, bank statements, employment history, income stability, and hundreds of alternative data points to rigorously assess their creditworthiness. Once a borrower passes this strict gatekeeping process, they are assigned a specific risk profile and listed on the platform. On the other side of the marketplace, you, the investor, log in and deploy your capital. Crucially, your money does not go to a single person. The true mechanism that makes this system work safely is fractionalization. If you choose to invest 1 lakh rupees, the platform does not hand that to one borrower. Instead, your capital is sliced into tiny components, perhaps 500 rupees each, and automatically distributed across 200 different borrowers. Every single month, as these borrowers pay their equated monthly installments, the principal and interest flow directly back into your investor account. This brings us to a massive structural regulatory shift that has completely redefined the P2P lending landscape in India, orchestrated by the Reserve Bank of India. Over the last couple of years, the RBI stepped in with incredibly stringent guidelines designed to clean up the marketplace and safeguard retail investors. The most profound operational change is the implementation of strict T+1 settlement rules utilizing independent escrow accounts. Funds cannot sit idle in an escrow account for more than 24 hours. They must move directly to the verified borrower or return to the lender. More importantly, the RBI has enforced an absolute ban on credit guarantees or assured minimum returns. No more masking default rates. Because of these strict guidelines, those closed user group matching models have had to completely restructure or wind down their investment arms. Those days are officially over. Today, transparency is the law. You see exactly who you are lending to, and platforms are forbidden from hiding defaults behind false promises. This regulatory transparency highlights the stark reality of risk versus return. In the current market, P2P platforms showcase yields of 10% to 14%. In an economic environment where traditional fixed deposits often struggle to outpace inflation comfortably after taxes, these double digit numbers are understandably compelling. However, we must be completely honest about the underlying math. The risk of borrower default lies 100% with you, the lender. There is no traditional bank capital, no government insurance, and no platform fund absorbing the blow if a borrower experiences financial distress and stops paying. Think of it like renting out a commercial property. If your tenant pays on time, your rental yield is spectacular. But if that tenant defaults, that financial loss falls entirely on you. The higher yield exists because you are stepping into the shoes of a credit provider, taking on the direct risk of individuals or small enterprises. Fortunately, you do not have to fly blind. The RBI has built robust structural guardrails right into the legal framework to protect you. First, there is a hard aggregate lifetime lending cap of 50 lakh rupees across all P2P platforms combined for any individual investor. Second, the regulations mandate a strict ceiling of 50,000 rupees for exposure to any single borrower across the entire ecosystem. This mandatory diversification across hundreds of microloans is your absolute best shield against defaults. Capital remains protected. If you spread capital across 500 borrowers, a few defaults might drop your yield slightly, but it transforms risk into a manageable statistical line item. Now, let us discuss how this income affects your bottom line through taxation. P2P interest is classified as income from other sources. It is critical to recognize that this income is taxed at your progressive income tax slab rate. Every rupee is added directly to your taxable income. Therefore, if you are in the highest tax bracket, a significant portion of those double-digit gains will go toward taxes, meaning you must always calculate your net post-tax yield. P2P lending serves as a tactical alternative fixed income tool. It belongs in a separate, carefully controlled bucket for monthly cash flow. Now for the surprise. As a bonus, I have created an in-depth guide to the 7 costly tax traps for high net worth NREs. Click the link in the description. Managing wealth successfully across generations requires a healthy balance of curiosity and a deeply rigorous commitment to due diligence. Peer-to-peer lending has matured into a sophisticated marketplace, but it demands an investor who thoroughly understands the rules of the game. If you want to analyze your wealth architecture, we invite you to begin that conversation with us. At EPK Capital, we build wealth for generations.